Here's a detailed summary of JPMorgan Chase's 2025 Q4 earnings call transcript, focusing on key financial metrics, management's outlook, risks, highlights, and important statements from the CEO and CFO. JPMorgan Chase 2025 Q4 earnings call summary. Good morning. JPMorgan Chase reported strong fourth quarter 2025 results, demonstrating resilience and strategic investments for future growth. Key financial metrics for Q4 2025. Net income, $13 billion EPS, $4.63 ROTCE, return on tangible common equity 18%. Note, these results included a previously announced $2.2 billion reserve build for the Apple Card portfolio. Revenue, $46.8 billion, up 7% year-on-year. This growth was primarily driven by higher markets revenue, increased asset management fees, growth in auto lease income. Net interest income, NII, ex markets saw increases from higher firm-wide deposit and revolving balances in card, partially offset by lower rates. Expenses, $24 billion, up 5% year-on-year. The increase was attributed to higher volume and revenue-related expenses. Compensation growth, including office hiring, partially offset by the release of an FDIC special assessment accrual. Full year 2025 highlights, excluding significant items. Net income, $57.5 billion EPS, $20.18 revenue, $185 billion ROTCE, 20% balance sheet and capital, standardized CET1 ratio, 14.5%, down 30 basis points sequentially. This decrease was due to capital distributions and higher risk-weighted assets, RWA, particularly the Apple Card purchase commitment, which added approximately $23 billion in standardized RWA. Advanced RWA, higher than standardized RWA due to the Apple Card transaction, contributing about $110 billion. This elevated level is temporary and expected to reduce to approximately $30 billion in the near term. Business segment performance. Consumer and Community Banking (CCB) net income, $3.6 billion, or $5.3 billion excluding the Apple Card reserve build. Revenue, $19.4 billion, up 6% year-on-year, driven by higher NII on increased revolving balances in card and a better deposit margin. Highlights. Consumers and small businesses remain resilient, with debit and credit sales volume up 7% year-on-year. Strong franchise growth with 1.7 million net new checking accounts and 10.4 million new card accounts for the full year. Corporate and Investment Bank (CIB) net income, $7.3 billion. Revenue, $19.4 billion, up 10% year-on-year, led by higher revenues in markets, payments, and security services. Outlook. Expect strong client engagement and deal activity in 2026, supported by constructive market dynamics. Investment Banking (IB) fees were down 5% year-on-year due to a strong prior year compare and deal timing. Markets revenues saw fixed income up 7% and equities up 40%. Asset and Wealth Management (AWM) net income, $1.8 billion. Pre-tax margin, 38%. Revenue, $6.5 billion, up 13% year-on-year, driven by growth in management fees on higher market levels, strong net inflows, $52 billion for the quarter, and higher performance fees. Highlights. Record client asset net inflows of $553 billion for the full year. Corporate, net income, $3.7 billion. Revenue, $1.5 billion. Management's forecasts and outlook for 2026. Net interest income, NII, ex markets, expected to be around $95 billion, following the forward curve which assumes 2 rate cuts. This will be offset by continued loan growth in card and modest firm-wide deposit growth. Total NII expected to be around $103 billion, with markets NII increasing to approximately $8 billion due to lower funding costs. Adjusted expenses expected to be around $105 billion. This growth aligns with opportunities across businesses and reflects an optimistic outlook for long-term investments to secure competitive positioning. Credit card net charge-off rate expected to be approximately 3.4%, reflecting a continued resilience of the consumer. Significant risk factors. Stablecoin regulation. Concerns were raised about the potential for a parallel banking system creating risks for insured deposits, if not appropriately regulated. Credit card APR caps. Management believes that imposing caps on credit card interest rates would lead to significant loss of access to credit, particularly for subprime borrowers, and negatively impact the industry and the broader economy. Geopolitical risks. Jamie Dimon highlighted geopolitical instability as an enormous risk that could impact the economy. Deficits. Large deficits in the U.S. and globally were noted as a potential future concern. Competition. The environment is becoming increasingly competitive, necessitating ongoing investments. Regulatory overreach. The potential for executive overreach in regulatory decisions was mentioned. Highlights. Consumer and small business resilience. Despite weak consumer sentiment, underlying data for consumers and small businesses remains largely consistent with historical norms. Strong franchise growth. Significant acquisition of new checking and card accounts, along with record households in wealth management. Apple Card acquisition. Viewed as an economically compelling transaction with a win-win-win for all parties, expected to accelerate modernization efforts. Technological investment. Continued investment in technology, including AI, to drive efficiency and enhance customer experience. Non-bank financial institution, NBFI, lending. Management provided detailed clarification on their definition and risk assessment of NBFI lending, highlighting structural protections and a low loss history, while acknowledging mindful of risks. Lowlights. Increased expenses. A notable $9 billion year-over-year increase in expense guidance for 2026, driven by strategic investments. Slower deposit growth. Consumer deposit growth is expected to be more modest than previously anticipated due to yield-seeking flows remaining, albeit at lower levels. Temporary RWA increase. The Apple Card transaction temporarily increased RWA, impacting CET1. Most important statements from management. Jamie Dimon, Chairman and CEO, on the macro outlook for 2026. In the short run, call it 6 months and 9 months and even a year, that's pretty positive. Consumers have money. There's still jobs even though it's weakened a little bit. There is a lot of stimulus coming from one big beautiful bill. Deregulation is a plus in general. On geopolitical risks. Geopolitical is an enormous amount of risk. I don't have to go through each part of it. It's just a big matter of risk that may or may not be determine the state of the economy. On investments. The $9 billion of investments. I think you should be saying if you really believe that they're real, you should be doing that. That's the right way to grow a company. On capital. We have tons of capital. There's no scenario where capital is gonna be the issue. You could make the system with less capital change liquidity and make it safer. Jeremy Barnum, Chief Financial Officer, on Q4 2025 results. This quarter, the firm reported net income of $13 billion and EPS of $4.63 with an ROTCE of 18%. On 2026 expense outlook, we expect 2026 adjusted expense to be about $105 billion. Broadly, the expense growth continues to align with where we see the greatest opportunities across our businesses. On credit card APR caps. When you just basic economics, when you start with that as your starting point, the right assumption about what the response of the system is going to be to the imposition of price controls is not that you will simply compress the profit margins. What's actually simply going to happen is that the provision of the service will change dramatically. Specifically, people will lose access to credit. On Apple Card integration, the integration is going to take 2 years for a reason. We feel confident that we'll get it done successfully, and I think the process of getting it done in a narrow sense is going to make us better. Just generally accelerate and challenge our modernization agenda. On capital requirements, the answer to that question is do every part of the methodology across RWAGSIB and stress testing correctly supported by data to get the right answer for that individual thing. And whatever the sum of those things is what it is. In summary, JPMorgan Chase delivered a robust fourth quarter, demonstrating continued strength across its business segments. The company is strategically investing for future growth, navigating a complex economic and regulatory landscape, and maintaining a strong capital position. Management remains focused on client service and long-term value creation, even amidst evolving market dynamics and potential risks.